So before we move on, I'm going to introduce my group member. First, Muhammad Azamuddin bin Azudin. Second one is Muhammad Aiman bin Razali. The third one is Marha Alfa binti Mahadi. And the last but not least, Nur Mariana binti Muhammad Husni Zain.
Hello everyone, we will begin our video presentation with a brief of introduction. For our presentation, we will cover two main parts, which are investment appraisal analysis and SME industry review. First, for the investment appraisal analysis, we explain the investment appraisal is and why it is important for business growth. We identify the relevant cash flows involved in the project, such as the initial outlay, annual differential cash flow, and terminal values. Then, we apply two decision techniques, which are the payback period and net present value, to help us decide whether the project should be accepted or rejected. Next, for the SME industry review, we give a brief overview of small and medium enterprises. We also discuss some key challenges faced by SME based on our article assigned to our groups to better understand the current SME environment. This introduction will help set the context for the analysis and recommendation in our presentation.
So what is investment appraisals? Basically, it's a process of evaluating the attractiveness, viability, and potential profitability of an investment project before committing resources to it. It helps businesses and individuals decide whether or not to invest in a particular project or asset. So, what is the purpose of investment appraisals? First, to assess the potential return on investment. Second, to compare different investment options. Third, to minimize risk and make informed decision. And the last is to ensure that the capital is allocated to projects that add maximum value to the business. And the key element in investment appraisals is first, initial outlay, the immediate cash outflow necessary to purchase the asset. Second, differential cash flow, annual cash inflow that will be received for year to year until project mature. And the last but not least is terminal cash flow. It's cash flow that occurs only at the project's termination.
Next, moving on to the project benefit and cost for Rumia Syndrome Berhad. Before we can find the initial outlay, we have to calculate the tax impact of selling the old machine. For annual depreciation, the old machine costs 950,000 ringgit with 100,000 ringgit salvage value over 10 years. Using the straight line method, that is 85,000 ringgit per year. For book value, since we own it for 3 years, the accumulated depreciation is 255,000 ringgit. Subtracting that from the original cost gives us a current net book value of 695,000 ringgit. For tax gain, we are selling it today for 600,000, which is 95,000 ringgit less than what it's worth on our book. We multiply that loss by our 24% tax rate to get a tax gain of 22,800 ringgit, which act as a cash inflow. Next, we calculate the initial outlay for Rumbia Syndrome Berhad. First, we determine the total cost of the new machine. We take the purchase price of 2.3 million and add the capitalized cost, which is 108,000 ringgit for custom duty, 25,000 ringgit for transportation, and 20,000 ringgit for insurance. This gives us a total machine cost of 2,453,000 ringgit. We also include the 30,000 ringgit training cost and the 250,000 ringgit investment in inventory. Finally, we offset this by selling our old machine for 600,000 ringgit. Because we sold it for less than its book value of 695,000 ringgit, we realized a loss, which gives us a tax gain of 22,800 ringgit. After adding our costs and subtracting our inflows, our net initial outlay is 2,110,200 ringgit. Now, let's look at the depreciation for the new machine, which affects our annual cash flows. For total depreciable value, we take the full cost of the machine, which is 2,453,000 ringgit. We subtract the expected salvage value of 200,000 ringgit, leaving us with 2,253,000 ringgit to depreciate. For annual depreciation, since the new machine has a 7-year life, we divide that value by 7 to get 321,857 ringgit per year. Because we are replacing the old machine, we care about the difference in depreciation. we subtract the old depreciation at 85,000 ringgit from the new 321,857 ringgit to get an increase in depreciation of 236,857 ringgit. Next, we calculate the differential cash flow. We start with the benefit, sale increased by 600,000 ringgit and defect decreased by 105,000 ringgit, giving us a total benefit of 705,000 ringgit. From this, we subtract our incremental cost, overhead increased by 200,000 ringgit. We also calculate the increase in depreciation, which is 236,857 ringgit. Our net profit before tax is 268,143 ringgit. After applying the 24% tax, which is 64,354 ringgit, we get a profit after tax which is 203,789 ringgit. Since depreciation is a non-cash expense, we add back that 236,857 ringgit. This brings our annual differential cash flow to 440,646 ringgit. Finally, we calculate the terminal cash flow. There are two main components here. The first one is salvage value. We expect to sell the new machine for 200,000 ringgit at the end of its useful life. And then the working capital recovery, the 250,000 ringgit is for inventory. By adding these two figures together, we get a total terminal cash flow of 450,000 ringgit.
Major decision making. The project requires an initial investment of 2,110,000 at year zero. It generates 440,646 annually for 5 years and additional 450 at year 5. After discounting cash flow at 50% of the NPV is RM 409,326. Based on the definition of NPV, we will reject because negative NPV means value is reduced. And for the payback period, we will accept it because the payback period is 4.79 years, which is within 5 years. Final decision, NPV is more reliable, therefore the project is rejected. Small and medium enterprise SMEs. Small and medium enterprises, commonly known as SMEs, are businesses that operate on a smaller scale compared to large corporations, but they are very important role in the economy in Malaysia. SMEs are classified based on annual sales turnover and number of employees, covering sectors such as manufacturing, services, agriculture and construction. Small and medium enterprises (SMEs) contribute significantly to economic growth by increasing production, boosting GDP, and stimulating trade and investment. Second, job creation, as they are major employers, especially in developing and emerging economies. Thirdly, innovation and entrepreneurship by introducing new ideas, products and services, and encouraging a culture of creativity and risk-taking. Lastly, local and national development through balanced regional growth, utilization and local resources, and reduction of income disparities.
So next, we move on to the review and summary of our articles. So our articles is about financial management strategy for SME. So the article emphasized that small and medium enterprise (SME) are fundamental to economic development, innovation, and employment creation. Despite their importance, SME face distinct financial challenges such as limited access to capitals, weak financial planning system, lack of expertise, and vulnerability to market fluctuation. So the purpose and objective of the study is first, cost control measure, analyze strategy to control operational costs without compromising quality. Next, working capital efficiency, investigate method to streamline working capital management. Last but not least is technology integration, explore technological solution for automating financial process. First, key financial challenges faced by the SME. The first one is limited access to formal finance. Many SMEs struggle to obtain loans from the traditional banks due to lack of collaterals and weak credit history. The second one is poor financial literacy. SME owners often lack knowledge in reading financial statement and budgeting. The next one is core financial management strategy. First one is budgeting and financial planning. We need to set realistic financial goals and allocate resources effectively. The next one is cash flow management, regular cash flow forecasting efficiently collecting system. So the third one is role of financial planning in SME. The article distinguishes medium-sized enterprise from startups, noting that they are critical growth stage. Financial planning helps them to manage expansion, allocate capital wisely, and forecast future needs. The last one but not least, strategic financial decision making. The article stressed that SME must adopt a strategic mindset rather than making a short-term financial decision. Key decision areas include capital budgeting, cash management, and financing structure. So, for the critical review, for the strength is practical orientation, clearly relevant to real-world SME challenges, and emphasize on adaptability and sustainability. So, the limitation is lack detailed empirical data, more conceptual than statistical, and some sections are repetitive. So, for the conclusion, the articles conclude that SME are vulnerable not only due to external factors, but also because of internal weaknesses such as poor planning, limited knowledge, and weak risk awareness. Effective financial management is presented as the cornerstone of SME success. By adopting structured budgeting, diversified financing, digital tools, and risk management framework, SME can become more competitive and growth oriented.
Next, I will explain about the investment appraisal process for Rumbia Sendirian Berhad. The investment appraisal process helps the company decide whether replacing the old machine with a fully automated machine is a good financial decision. It focuses on analyzing relevant cash flows and using decision-making techniques to support management decision. First is the initial outlay. It represents the net cash investment required at the start of the project. For Rumbia Sendirian Berhad, this includes the purchase price of new machine, capitalized costs such as custom duties, transportation and insurance, additional investment in inventory, training costs for operating the new machine. This amount is reduced by the cash received from selling the old machine, including the related tax benefit. Next is the differential cash flow. This represents the additional annual cash inflow from using the new machine instead of an old one. It is calculated by comparing the increase in revenue, changes in overhead costs, and saving from lower defect costs. Although depreciation is non-cash expense, it is deducted to calculate tax and then added back to get the actual cash flow. And finally, we have terminal cash flow. This occurs at the end of the project's life and includes the salvage value of new machine and the recovery of working capital. These amounts are adjusted for opportunity costs related to the replacement decision. Lastly, this slide shows our final advice to Rumbia Sendirian Berhad. Our group advised Rumbia Sendirian Berhad should reject the machine replacement project. Although the project meets the payback period requirement because the initial cost can be covered within 5 years, this method only shows how fast the money is returned. It does not consider the time value of money or the company's required return. The NPV is negative. This means the project does not earn the required 15% return and will reduce the company's value. Since NPV is better decision making method than payback period, the company should follow the NPV result. Therefore, the final decision is to reject the project.
Now we have reached the final part of our presentation, which is the conclusion. So, in conclusion, this presentation highlights the importance of effective financial management and investment appraisal for the success of SMEs. Although SMEs contribute significantly to economic growth, they face financial challenges such as limited access to funds and weak financial planning. The investment appraisal for Rumbia Sdn Berhad shows that while the project meets the payback period requirement, the negative net present value (NPV) indicates that it does not meet the required return and would reduce company value. Therefore, NPV provides a more reliable basis for decision making. Overall, SMEs must adopt sound financial planning and strategic investment decision to ensure long-term sustainability and growth. And that's all for our presentation. Thank you.